All right, good evening and welcome. So, first and foremost, this will be a review for the morning session. First of all do the annotation of it, and then do the commentary will come after that. So, I'd want you to pay attention to the annotations, everything that is being annotated here on the 15-minute time frame. So, we'll start here at the on the 15-minute time frame to be quick. All right. So, in going into this time frame, before all of this bearish order flow has been printed, we had this rally higher, this particular rally. So when price was rallying higher here, we're interested in this imbalance here. So we draw this imbalance out in time. When you have a fair value gap like this, coupled with another fair value gap just before this fair value gap, you overlap all of it together as one fair value gap. So you draw all of this out in time. So here you had this 15-minute fair value gap. So because price does one of two things to rebalance an imbalance or pair up liquidity. So here you have this 15-minute fair value gap. So this was our John liquidity going into the morning session. All right. So we're waiting for the equities open. And when you're waiting for the equities open, you look for where the previous day's close was. So the previous day's close was at this low. Yeah. So we had this close here at 6:45. At this is 6:45 candle here on the 15 minutes on the previous day, which is Wednesday. So here will be the opening range gap low. I'll explain. So when you've noted this as the opening range gap low, because we are currently at a premium now, when we open at 9:30 opening price, that will be the opening range high because we've currently had this rally higher, so it is at a premium. So we have this opening range gap high. I remember the understanding of premium and discount. The algorithm goes from a premium PDRA to a discount PDRA to deliver an efficient price delivery. Right. So now we had all of this going down to the lower time frames to understand the IPDA footprint that went on. So from the 15 minutes, we'll just drop lower to the 1 minute time frame to do the annotations. So on the 1 minute time frame, we had this. So we had this relative equal lows here, which was sensor liquidity. And also these lows. So you had sell side liquidity resting below these lows here, which is just above our John liquidity, this 15 minute fair value gap. So this was our John liquidity. So when we had this rally higher here, we're watching price diligently. This was all done live. So you can look at the live session for the morning session on for the 17th of October. So during this rally higher, when price was going higher here, we you look at correlating assets because when trading, it is advisable to look at multiple correlating assets and also inversely correlated assets to get a bearing and measure what price is trying to do across all markets. So when we had this rally here before 9:30, yeah, just before 9:30, the Nasdaq was failing to come for these highs. I would want you to go to your chart and use this compare button. Use this compare button here, this compare side, and you pick the Nasdaq and the Dow. Do that by yourself for your own study because it will help you to understand the idea of SMT and understanding the relationship between intermarket analysis. So the three indexes was, which is the S&P, the Nasdaq, and the Dow index. The Nasdaq was failing to come for these highs. It was failing to take these highs. So was the ES failing to come for these highs. But the Dow was extremely bullish, coming for its high here. So when you add that, that is SMT. SMT being the Nasdaq and the S&P willing to go lower, but the Dow is unwilling to go lower. So when you add that, that is an indication and confirmation too that yes, you are on side with the market to go lower, right? So we had that here. So this, when price rallied here at 9:30 open, we opened here, which is the opening range gap high, and then we rallied higher here to take out these highs and failed to take this particular high, but to rebalance this imbalance here. When we did that here, we dropped lower. Immediately we get this drop lower, you go you you identify your opening range gap, the range between the opening range gap, and you look for the equilibrium of it. The consequent encroachment of the opening range gap is your first target, because typically about 75% of the times, the when we open at a premium, price will come to a discount at the equilibrium, which is the consequent encroachment of the opening range gap. So you measure the high of the opening range gap and the low of the opening range gap, and you look for the consequent encroachment of that gap. That is your first target, because price is always likely to come to that opening range gap. And as you can see, the consequent encroachment of this opening range gap is coinciding with this John liquidity, which is the 15-minute fair value gap here, right? For a higher probability trade setup, for a higher probability trade setup, you'd want to have multiple points for taking partials of at least two liquidity pools for partials, for taking partials. So you have this first sell side liquidity, then you have this second sell side liquidity before you get to your target. So this is already indicating the higher probability trade setup. So when price drop lower, we had this imbalance created in price here. So you would not want this imbalance to be filled completely, or it is when you have it like this not being filled at all. This is a breakaway gap, and you want to see this kind of signature in price. When you have this kind of signature in price and you get any rally higher, as you get the rally higher, you do not need to see, as you get the rally higher, you're not expecting price to come back to the opening range gap high, or this swing points that made this, or this swing points that formed at 9:30. So when price made this breakaway gap, you become bearish, seeking lower prices. Yeah, you already have SMT confirmation behind you, solidifying your trade idea. So we had 9:30 open here, drop lower, creating a breakaway gap here. So this is a breakaway gap. So we had this breakaway gap here, and you do not want a breakaway gap to be filled, hence expecting lower prices. And when you draw this out in time, these imbalances here, you can stretch all of these imbalances out in time, like we explained earlier, from this low, from this candle's high to this candle's low. When you draw that out in time, this becomes an inversion fair value gap, because you're seeking a bearish narrative. And when seeking a bearish narrative in price, every BC will become an inverted fair value gap, taking price lower. And as you can see, we traded to the high of this BC here. We traded to the high of this BC here to invert price lower. And you can see consecutive body closes below this consecutive encroachments. This is further solidifying your narrative for a bearish buyers. All right. So that was the business that was done on the live stream. You can go to the live stream at that was done during the morning session, and you see the inner dialogue being communicated in real time, right? All right. Hope you got something from this video. Trying to make it as concise and precise as possible. Have a nice day and good luck and good trading.